But what the capitalists forgot is that capital shifts. And I think one of the biggest trends that we've seen is actually the fragmentation of wealth.
Hey everybody, welcome to episode 60-something of WealthTech Unwrapped. I'm not entirely sure what episode it is. We've done so many. And before we jump to a guest, somebody I've known for like 10 years, I think I'm going to start each program with just a little bit of thoughts on WealthTech for the week. Remember, I used to do, or I remember, maybe I don't know how many of you watched it, I used to do this kind of weekly news digest of WealthTech. So we've stopped that, but I kind of miss it talking about it. So each week I'm going to kind of just give you some thoughts from the WealthTech news. I used to work for E-Trade a long time ago, one of the original online brokers that most of you millennials have never heard of. You thought Robinhood was the original. It wasn't. It was E-Trade and Charles Schwab, to be fair. Anyway, 3 or 4 years ago, Morgan Stanley brought E-Trade, which was one of their forays into digital broking. And just this week, Morgan Stanley decided that E-Trade will take over all of their robo-advisor clients and that Morgan Stanley would scrap their own robo-advisor and that it would all transition to E-Trade. And what they said was, digital wealth is becoming essential to Morgan Stanley. Honestly, made me super happy, partly because I was at E-Trade before, partly that one of the huge firms of Wall Street brought them and then understood that there was huge value there. I think it's going to happen more and more. Like, you know, obviously I'm talking up my own company as well because Bamboo's going to work with some of these leading institutions like we have with Standard Chartered and others, but it's happening. Like people used to tell me that robo wouldn't happen. Well, now so many of the biggest firms. We saw Fidelity recently double down on Fidelity Go. Now we're seeing Morgan Stanley do it, and I think more will come. So that was it for me this week, seeing my old firm taking over one of the institutions of Wall Street on the robo-advice side. So exciting for me. And this week we have Raj. So if any of you are in Singapore in the fintech scene, you know Raj. He started SmartKarma about 7 years ago. We had a fun interview. He was an entrepreneur before most of us. So I have enjoyed talking with Raj many times. I look forward to this chat now. Let me introduce Raj from SmartKarma. Oh, all right. We are on episode, I was going to tell you what episode we're on, but I don't know. 60-something. So
Right.
we're almost there. And Raj, how long have we known each other now?
I think it's coming close to 10 years.
Yeah,
perhaps.
exactly.
Yeah, a long time. Yes.
So it's about time we had you on the podcast. So, you know, look, WealthTech Unwrapped, like sometimes I think I didn't just call it WealthTech Unwrapped because it's not just to talk about wealth tech. Like when you started SmartKarma, I remember thinking, oh my God, that's what I used to do like 20 years ago. You just did it better, smarter, faster. So I think we could talk about wealth tech and everything today, but why did you start SmartKarma? Because you know what someone told me the other day? Don't be a founder unless you really want to, because this stuff is hard.
Yes. Startups are for the crazies, as I tell my team. Look, I mean, first of all, SmartKarma is not my first startup. It's my second proper one, I should say.
Well, you had a range of improper ones.
Yeah, oh yeah, absolutely. I mean, I did grad school out in California at Stanford, and you know, I caught the bug then. That's when I did the first one. Unfortunately for me, my business partners then got enrolled into the US Navy, got sent to Afghanistan, then Iraq, and it was very hard to pull off a startup.
That's probably harder than a startup, right?
Yep. Well, I don't know. He still had Skype, but you know, we didn't have Zoom in those days, and it was kind of hard to run a distributed team. So that didn't go far. But I kind of left the big bank world in Jan 2009, sort of in the throes of the great financial crisis, to start our first little company, which was called Aviate. And there was nothing techie about it. It was a boutique brokerage firm. And
oh my God, that's right. I remember Aviate. Oh,
that's
yes,
right.
You were there.
So I was kind of part of the early crew that joined. I wasn't the main founding partner, but we was sort of still fairly early in the game. I helped build out that business, especially some of the growth in international markets like Southeast Asia and so forth. And I was in my mid-20s then. So it was sort of, you know, pretty exciting time to be venturing out, dealing with regulators, getting licensed when, you know, Lehman was blowing up, and here we were, 2-bit brokerage, trying to get set up.
I mean, I started my career in 2-bit brokerages, so don't worry, I know the idea.
But that was phenomenal fun, and I think we scaled faster than any fintech I know today, really, in the market. But of course, this was a very 1.0 business model. It relied on trading commissions for revenue. But I think it gave me the chutzpah or the confidence that then eventually sort of translated
I
into
remember when you
SmartKarma,
got,
Many,
like,
and so on.
I don't remember all the names at Aviate, but you had guys who had relationships, right? In that firm, I remember when you guys started, I was like, okay, these guys just kind of by, I don't know, force of will or force of relationship, there were some good guys there, right?
Oh yeah, absolutely. I think the quality density in that organization was second to none.
Yeah.
And although we never said it, but unofficially, it was sort of, we don't want more than 50 clients, but we want to be very meaningful to each one of them. So, let's call it revenue per client or any of those metrics, we were exceptional.
Yeah.
We were doing more revenue than some of the larger banks out here. And
crazy.
having a lot of fun as well.
Yeah,
Mind
yeah.
you, we were the most relaxed brokers in town. There was no dress code before the
Back
start.
then, exactly.
Back then.
You had to wear.
Back then. There was, we had a big beer freezer in the pantry. Clients would walk in and out at lunch hour. But, we were the guys people trusted.
Yeah, I remember.
And that was fun. And when we had an exit very early on, I think in our second year, towards the end of the second year, we got acquired. I was part of the team that led quite a lot of those discussions.
Wow. And you were still, how old were you then?
I was probably 27.
This gives you an amazing distorted view. You're like, wow, I did a startup, my first one, and 2 years in it got acquired. This is normal. This is not normal, as you now know.
It wasn't normal then. And even in that 2-year period, I think I had sort of all the heart attacks that you normally have with startups. But it was all compressed. It was all very, very compressed. So after we had our exit, I continued to work with the new owners. We had I think a 3-year exit. I stayed on for about 4 odd years. I saw what happens to startups when they become part of larger companies, what works, what doesn't work. How differentiation is probably one of the strongest strengths of a startup, which can get, I guess, obliterated once you join a bigger firm that wants to be a me too. So there was a lot of learning, really, really good fun. But fast forward to the end of my time with that acquirer. And around that time, I was thinking of helping my parents and setting up some sort of a family office structure in Singapore. That was the central idea. And as I thought about that, as I thought about us managing our own wealth, I realized that almost none of the services that institutions receive from large banks are available to, smaller investors,
Totally.
be it families, be it high net worths, and so forth. They might think they do, but they don't. And there's a very big divide. In fact, many of the sell-side models preyed on that asymmetry of information, that arbitrage. In fact, that existed. So I paused on that family office idea. And I said, why can't we build a platform that democratizes access to X? We did not know what that could be. It could be trading, it could have been research, it could have been deals, it could have been anything.
You remember, I remember working in brokerage, right? People are like, first call, there was this idea, right?
Yeah.
It was this asymmetry, right?
That's
if
right.
you had the biggest commission check, you got the first calls, right?
Yep.
The people who needed the best advice didn't get it. The industry's it's a bit like the whole wealth industry.
It's capitalism, right?
It's
capitalism. But what the capitalists forgot is that capital shifts. And I think one of the biggest trends that we've seen is actually the fragmentation of wealth. It's certainly distorted when we look at assets with passives or the rich getting richer and so on. But at the same time, there are more millionaires in Asia than ever existed before. And so many more people are more affluent than they've ever been in the history of the world before.
Yeah.
And not all of them trust the big blue suit. And they want to do things in different ways, and they need access to services. So, we started off with a very simple exercise, which was, what are the main services that a bank provides? Which of those services have already been digitized or brought into a 2.0 world, which still remain to be, which are most challenging, less challenging, et cetera, et cetera. We looked at very basic analysis, and we met with a lot of people. I think I was on a 6-month gardening sort of period, which made it easy for me to just have a lot of meetings.
So you didn't start it with, oh my God, I have to do independent research. I have to do this. No. You started with, we're going to work out where the services could be offered.
That's right.
Digitally.
Yeah. Huh. And we started off just thinking we knew that the investment bank had to be rebuilt, was going to be rebuilt. Today, if we look at today, I think the biggest capital, let's call it the biggest sub-segment of fintech where capital is going is digital banks.
Yeah, there's a lot of money going to that.
All of that, right? But that's just the consumer bank. In fact, it's the worst part of the consumer bank. It's the millennials, the small savings accounts.
There's theoretically no money in that, right?
There's no money in that. There's a lot of cost of acquisition in that. No money in that. Not for now.
Yeah.
But that's where VC capital, institutional interest is today. Go back 7-8 years ago, we said that the whole investment bank will become a digital investment bank. So we were focused on that part of the bank because that's the margin center. That's where the bank makes money. And we broke it down into the various pieces, and we studied each of these services, and we thought about which service can we rebuild, can we reimagine, and why.
Yeah.
And the conclusion was actually sort of a bit of a surprise for me too, because I don't come from the world of research. I actually come from the world of sales, equity sales. And we love the idea of research for just one simple reason, which is insight sits at the center of the ecosystem. And another way for me to explain it is if you think about markets, capital markets, it's actually just 2 arrows. One arrow is the flow of capital from a buyer to a seller.
Yeah.
The other flow is a flow of information. So there's just 2 loops in markets, the flow of capital, the flow of information. And we realized that if you overlay competitive intensity from newcomers, it was all on that flow of capital.
Yeah.
We're going to make faster, better, cheaper trading systems.
Yeah, absolutely.
That's where
I spent a lot of my career in that, trying to build E-Trade and exchanges and all of that. Yeah.
Nobody was thinking about the flow of information, except perhaps companies like Bloomberg.
Yeah.
They've been thinking about it for many years, and they're probably some of the best business models.
And they built a great business.
Right? We said, well, hang on a second. There are so many things happening right now when it comes to flow of information. First of all, we have an explosion in the amount of information.
Yeah.
You go back 20 years ago, you couldn't even find financial statements for companies in Asia.
So my first job was selling the Estimate Director. I don't know if you remember what it was. It was earning guides. We used to print it out. And I used to walk around Asia, well, not all of it, fly to places, with books, printed earnings guides.
Right.
Every month we would print it and hand it out. It was so unscalable.
We're seeing a phenomenal explosion in the amount of data and information about companies, about securities, about things to invest, so on and so forth. Which means there is the second derivative of that is there's going to be lots and lots of companies that build businesses around analyzing little bits and pieces of this.
Yeah.
So that's a fragmentation of expertise.
Yeah.
There is no one bank in the world that'll be able to put all these experts within the confines of its glass walls. It's just not possible, right? It's a cost center from a bank's perspective.
Absolutely.
And you can't scale that cost center.
And the other side is, like certainly 20 years ago when you aviate, people bundled commission and trading together, right? So you could get way overpaid. Sorry, trading and research together. You get way overpaid for it, right?
Yeah.
People didn't even, they would send out all these research reports, right?
Mm-hmm.
People didn't read them.
And if you went back in time and looked at the news headlines from that era, I mean, there was the Barclays CEO saying this is the death of the universal banking model. Banks can't be doing everything. Banks were shutting off commodity trading. There was, banks were trying to figure out what their core was and focus on this and so on. So there was this desire from incumbents to specialize and get rid of anything where they don't make sustainable returns, which makes total sense. We had new regulations, the MiFIDs of the world, which were very delayed reactions to what everybody knew. There was a lot of corruption. There was too much fees, and Bamboo, that better than anybody else. There's a lot of stupid fees knocking around with very little transparency.
The wealth industry it's getting better, but the amount people pay for advice and wealth, it's still the wrong price.
Yeah. So, so when we looked at, the Porter's 5 forces around that information loop, it was very attractive. There was diminishing competition. There was increasing need for a new tech-driven distribution model that could bring all the expertise together. Someone had to fundamentally rethink the economics. How do you price it? Bloomberg charges whatever it is, $24,000 for a terminal for all the data set.
And people use 5% of it.
Correct. But still, it's a single subscription.
Yep.
No one had done that with research, really. No one had thought about, the Spotify of research. And you really had a need for a new economy research or information company, right?
So I'm sitting today, SmartKarma works, right? You guys have done great, and I'm sure with all sides. I used to sell research. And if you told me this idea 6 years ago, I would have told you were mad. Mm-hmm. Because what I found was the people who consume it could get free research from the banks, right? Because they were just giving it out.
Yeah.
So wasn't there something that told you, like, today it's obvious, you guys got it right. At the time, was it that obvious? Like, because I promise you, 6 years ago, if you'd told me this is a good idea, I would have been like, dude, like I've been trying to sell independent. I used to do soft dollar, right? I used to do soft dollar trading. And it was just really hard. People didn't want to pay for research.
Sure.
Was it really obvious to you back then?
Look, I mean, different people value things differently.
Yeah.
I think bringing differentiated research that moves markets, there's always been a market for it. We just did not know the price for it.
That's a good point.
On the other hand, selling commoditized garbage, there's never been a market for it. Or if there was a market, the buyer was silly, right? And sometimes the analogy I use is you walk into a supermarket today.
Yeah.
You pick up the tin and you try and read what's inside.
Yeah.
If it's crap, you probably shouldn't buy it. But if you buy it, you probably don't want to pay too much for it. Whereas if something has good quality, pure ingredients, et cetera, it's organic or
nice
whatever it is,
the whole thing. Yeah.
you'll pay for it.
I will. That is
So
true.
the buyer is discerning.
Yes.
And back in the pre-MiFID world, the buyer didn't really need to be discerning.
Yeah, because there was just stuff everywhere. You could just
because that cost was stuffed to the end investor whose pension was being managed.
Yeah, right. Because they weren't paying for it. It was coming as part of the service from the
Because
banks, right?
when XYZ fund manager reports performance, it's net of all fees.
Yeah, right.
Nobody asks, what is that fees? Hang on a second. Because we're already paying you a management fee. So what is this fee? And then if the fund manager said, well, that's the trading and execution cost, like, but your trading commission rate is down 99% in the last 10 years.
Absolutely.
So why is this fee gone up? What is this? That was the fee that used to pay for, those trips to Vegas and the conferences and the blah, 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 and the blah, 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 and the blah, blah, blah.
Yeah.
All those unspoken truths, right?
Yeah.
But the cat was out of the bag.
Yeah.
And MiFID was just a very, very late reaction to reality. But what we had already started to see was a fundamental rethink of where research dollars were going to spend. A very simple example is, while you might have been struggling to sell some of the bank research back in the time, some of those research dollars were flowing to expert networks, for instance.
Now, and they had their time in the sun and their time not in the sun.
And now their time massively in the sun.
They're back again, the expert networks?
Well, they've been back for the last 14, 15 years. They're doing really well. I think GLG crossed $400 million of ARR a few years back. Hazy number in my head, but I think it's much bigger than that now.
And so I remember when expert networks got their bad days when people were like, but when you looked at it as a business, you're like, hold on, kind of makes that if this business is run well, it makes sense, right?
Right.
Some American company, for example, wants to enter Indonesia to do palm oil or whatever, and they don't know anything about it because they're in Dallas and they don't know where Kalimantan is.
But that's
they need
research.
an expert, right?
That's research.
I know.
So part of building a new economy research business is fundamentally restating the definition of research and opening it up.
Yeah.
If we look at SmartKarma today, and we've been doing it one step at a time. We started off building a very unique and differentiated research offering for institutional investors, people who are in the business of managing money. But did we focus on the benchmark funds? Did we focus on the type of money managers whose own business model we think is under trouble? No, we did not.
Yeah.
We focused on the alpha seekers. We focused on the guys who just did not care about benchmark returns.
Yep.
Because you could synthetically create it very cheaply, right? And these guys valued great research. They valued data-driven, differentiated research that had alpha. And they wanted proofs. They wanted, back tests and all of that. We built that framework, et cetera, et cetera. That's where we began.
Yeah.
The next thing is then we build research services for corporates. Because at the end of the day, most of the research is written about companies.
Yeah.
It could be listed companies. It could be soon-to-be listed companies.
Yeah.
It could be digital assets. It could be, you name it, right? But these firms deserved presence on our network.
Yeah.
So we built SmartKarma Corporate Solutions. We started off selling this to investor relations firms at corporates. We've just crossed about 2,500 corporates on our platform.
2,500 now.
Yep.
So you're providing them research on their, you mean it's how does it work?
So, we thought about it more broadly. We were a research network. We had research providers and institutional investors, producing and consuming research on companies.
Yeah.
We said, what would a company need out of this? They would need to know who's interested in us, how can we target them, how can we find new shareholders, can we stay on top of what people are saying about us, can we get a microphone to put our view forward, right? So we gave them a way to do all of that. So now corporates engage with analysts as well as investors through our platform. It's a start. Honestly, it's a start.
2,500 is not a start, man.
That's a start.
That's more than a start.
Look, I mean,
that's a lot.
There's a lot we need to do here. I mean, there are about 23,000 companies that have zero research coverage on them in the world. 98% of emerging market stocks have no research.
Because everyone just focuses on the big cap, because that's where the money's to be made, right?
I mean, but there's no alpha to be made. Right? So we try and focus on this 98%. I always say our TAM is 49 times more in numbers than what everybody else focuses on, right? In one very simplistic way, obviously. But we've been integrating corporates on, right? And as we built corporates, we made some mistakes. We didn't realize how IR procurement works, how budgets are, all of that sort of stuff. And we are adding 2 to 3 companies on a daily basis, and I hope those numbers keep up. We're very, very excited.
That's awesome.
Right? These are mostly listed companies because they have a well-defined IR function.
Exactly.
Now we started thinking about other types of corporates, the Bamboos of the world, right? Your needs are slightly different.
Definitely.
Right? You don't have the same investor relations functions that a listco might have, right?
I'm the investor relations team.
That's right. So for companies like you, we realized that a very good intersection between our research network and your needs comes in 2 forms. The first is thought leadership.
Yeah.
Any aspiring startup or private company needs to be able to communicate to its stakeholders, not shareholders, but stakeholders, why it's in an attractive category and why it's potentially a category leader.
Yeah.
They need independent analysis to back some of those claims and communicate that message. We found very, very few startups have internal expertise to do that.
It's because they're not built to do that, right?
They're not built to do that. That's not their business, right?
Correct.
And they also do not have the budgets to go to an EIU or a Gartner, Nielsen, McKinsey, whoever, to get any of that done.
So at one point, I was thinking about this a while ago. So I did go to one of those firms, and I did get a quote for a bit of work.
John Grant?
Yeah, I was going to say, good job. It was low 6 figures, which was 5 figures too much for me.
So here we had probably the largest research ecosystem around Asian markets, with analysts who knew these industry sectors and wanted to do more work. We had spare capacity. And we started, repurposing, productizing, and making some of these services available in our format, which is nice recurring subscriptions available to aspiring startups. And so thought leadership was the first. It's doing really well. And the second segment where we are exploring and getting better is market research for startups, and especially things like data benchmarking. A lot of times the metrics in the startup world are not known. If you compare, let's say, the 3 local banks in Singapore, you can pick up anything and their names and ROI, ROEs and whatever, all metrics, right? If I pick up the 10 digital banks in Asia, nobody knows nobody's metrics.
Yeah.
That's where we come in. We're building, again, there is a whole new economy of companies that's coming online. That's if all the VCs are correct. All of them need data-driven market research services. There's a huge white space. And we're sort of, incrementally growing into that. But that's, again, back 6-7 years ago, we knew that the research ecosystem touches everybody. As I said, our fundamental truth, the one truth we knew, was that insight sits at the center of the ecosystem. What is that ecosystem? Research providers, investors, corporates, and intermediaries.
And so these research providers, they don't work for you, right? They're all independent, but they know that, and this is what I found, they can't sell it themselves because they're generally not salespeople, they're research people, they're one-man bands, they do their research. So for you, like for them, you're like, I won't say the Superman, but you are the showcase for them now. You're
we're
the
distribution.
You're the distribution for them.
We're the distribution card.
Do you still use Spotify of research? Is that still your...
Others use it to describe us, and I don't mind it, except, in many ways, we have surpassed
You surpass Spotify in valuation. In valuation.
No, I wish. No, but for example, I think Spotify did one very smart move, which we kind of copied, which is they introduced podcasts, which is non-commercial content, because they realized the same user that listens to music also listens to podcasts, but has to use another app.
Yeah.
Okay. If we introduce that content, first of all, it's non-commercial.
Yeah, right. Yeah.
But you increase the stickiness, and
you become the central hub.
And you can potentially figure out how to monetize non-commercial content. You see, and it improves the unit economics. It has the potential to improve the unit economics in a very profound way.
Yeah.
The market doesn't see that right now because they haven't begun to monetize podcasts, but it's coming. If you look at what they've acquired and the tech they've built.
Who's Spotify?
Spotify.
I mean, they paid what, 100 million for Joe Rogan or something?
That was, no comments. I don't think that was smart. But they built some ingenious tech to monetize non-commercial content.
Yep.
Which I thought was great because that improves your gross margin.
Yep.
The thing that they have not done, but something that SmartKarma has done, is premiumize. There is no Spotify premium. There are no premium services.
Yep.
You still can't buy your concert tickets, not really.
Yeah.
There are no premium subscriptions. SmartKarma has done that. In fact, if I look back at the last 12 months, almost 40% of my new revenue comes from premium subscriptions.
What do you get? What do they get?
So SmartKarma Premium Services is a whole set of services that sit on top of the basic platform.
Yeah.
Right? So as an example, if you're an institutional investor, you buy a login to SmartKarma at about 10 grand a year, right? That's the basic access. You can read any research that we have with it. It's personalized, it's got all the recommendation systems, all of that. You can even chat with the analyst, which is something you can't do with the bank.
Do they pay extra to chat with the analyst?
No, that's all SmartKarma, the basic platform.
Yep.
But now, let's say you want to go deeper with a specific analyst. You want the ability to speak to them. You want the ability to get them to help you with certain models, or you want access to premium data that powers some of their research. All of that, those are premium subscriptions. So we've premiumized. So now there's a very natural upsell from a free account to a paid platform account to a premium.
But you had to get to mass scale to get there, right? You couldn't have done that in year one, right?
No
in
way,
year one,
no way.
Is it year 7 now for you guys?
Yeah. So the platform, I call that the discovery layer. That's how people find out who's good at what, who are the key opinion leaders of this world. How can we get in touch with them? How can we get more information? And then, you
Do you make any of your research people exclusive to you? Like, because to me, like, let's say, so you remember Chris Wood from CLSA, right? Greed and Fear, his report, right? Yeah. Which was like the absolute report everybody wanted, right? And, it was exclusive and you went to CLSA. But would you do that? Would you, like, let's say you found an analyst who you just knew was a killer at Indonesia, whatever it might be, right? Research. Would you make them exclusive? Because
there are two ways to make somebody exclusive. There is the expensive way, and there's the smart way. You can think which one we do. The expensive
As a startup, it's surely the expensive way, right?
The expensive way is to give some guy some sort of guaranteed salary and blah, blah, blah. And then what happens at the end of that period, they go and they do what Chris would do, go to Jeffries.
Correct.
Right? And then CLSA doesn't have Chris Wood anymore. And then Jeffries gets him at X plus 10% and so on and so forth. Great trade for Chris Wood, not such a good trade for the organization.
Yep.
So we don't do that. What we do is we make sure we dominate, we become the most dominant revenue channel for a particular provider.
For that. So he can't leave you, right?
So when he starts on day one, 100% of their revenue comes from their own means, whatever it might be, their own sales efforts, their legacy clients, et cetera, et cetera. What we want is that by X time, 90% comes from us.
Yeah, right.
The moment that happens, the equation is tilted the right way. So, because at that point of time, if they leave our platform, they leave 90% of their revenue.
And no one's going to do that. How many people do you have? How many researchers?
So we
I mean, they don't have because they're not yours, but
yeah. And in fact, our supply has changed a lot. But I think we report or we count in terms of companies, not in terms of individual analysts, because that's too volatile a number, but probably at about 250 content providers. And that's a very large number because, if you take the largest APAC-focused investment bank, they'll probably have a team of 80 or 90 analysts, roughly, in Asia.
Yeah.
So we have 250 companies.
So okay.
And the smallest company would be a one-man band.
Yeah, okay, so.
The largest company might be a few hundred people, but it's very, very few. But, on average, it would be high single digit.
I was going to say five-ish.
Five-ish.
Yes.
Yeah, exactly.
So over 1,000.
Could be. Again, we try not to count that.
But if you took that on your cost base, so let's say you were a bank, and you employed those 1,000 content providers, there's no economics that makes it work, right?
Well, without naming a bank, but let's look at a bank that has about 90 analysts in APAC.
Right.
And
90.
90. And this one of the typical bulge brackets. And I'm talking about guys who have analysts in Tokyo and Sydney and all that.
Yeah.
On 1st of Jan of any given year, their fixed costs, which doesn't include bonuses, fixed costs would be about $100 million.
So $1 each.
Yeah.
Yeah.
That's, headcount costs plus.
All in.
All in, right. So you're $100 down in fixed costs before you've begun.
Wow.
So that's your break even on just that part of the business. Then you have sales, you have trading, you have all of that, all of the other stuff. And then on top of that, you get beautiful things like COVID and QT and blah, 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 right? So, and your revenue is entirely variable because it's linked to trading commissions and market volatility and so on. So you've got the world's worst business model. You've got high fixed costs, 100% variability in revenue.
It was good when it was good, right?
Yeah.
It was super good when it was good.
I mean, back in 05, 06, let's say you bought shares in an Indian company as a foreign investor, you were paying 200 basis points round trip.
Yeah.
Right? Today you pay 2 basis points.
Jesus Christ.
That's 99% drop. Right? So when your revenue falls 99% and your cost is only growing, good luck.
It's a good place for your business. So,
but you see, you have to take a long-term bet. These are not, and I always tell our investors, this is not a get-rich-quick scheme. If you want that, you can buy Luna. This is
or not, as the case may be.
This is SmartKarma. There is sustainability and a very different kind of J-curve. And what we're building is basically a whole new utility for capital markets. That takes time. It's got to be done properly.
So, and not to stroll too much into the weird world, I went to Token 2049 just to see the craziness for myself. Mm-hmm. And I remember, and I spoke to somebody afterwards, I'm like, Bamboo, we do boring stuff, help people save for the future. And they were like, yeah, but boring's boring. Yeah. Like that's, we've talked about this, right? You've always said, SmartKarma's not
We're boring.
We're boring. It's hard to sell boring sometimes, right? Yeah. Like that's, I remember walking, just this last week, walked into 2049, whatever it was. It was like a rock concert, a cult, and a conference. It was this mixture of, do you find it hard? Like sometimes, like the investors, they're all.
I mean, look, I've been in markets long enough to know that at any given point of time, there's always going to be a flavor of the day, right? And, there are two types of people that like the flavor of the day. The first is people who have very little money, but they want to grow it to a very large number very quickly because that's the only way they think they can make it. They see no other way.
Yep.
Back to that other podcast example you were sharing, the desperate treasure hunters.
Absolutely.
Right? They are buying, let's be clear, they're not investing or saving, they're buying lottery tickets.
Right.
Right?
Lottery tickets will never go out of fashion.
So that's number one, right? That's one. So there's the lottery ticket buyers.
Yeah.
And then the only other class are the momentum junkies. Who are like, this is what's trending, let's put more money. The CTAs of the venture world.
Of
That's
course.
it. And we all know what happens to CTAs. They do very, very well for like 4 or 5 years while the trend is there, and then they lose all the return they made in the last 4 or 5 years, right? Because they don't fundamentally have conviction. They're just following somebody else's trend.
Yeah.
That's it. So, for us, I always love such investors. That's what makes markets. They're providing liquidity. That's an essential purpose.
Yeah.
That doesn't mean you need to do the same thing. You could, like, up to you, Bit of digression, but do you know where the word invest comes from?
I do not.
It comes from the word investra, which is very, very similar to a Sanskrit word called vastra, which means cloth. Okay? And it actually referred to the shroud in which you were wrapped when you passed on. So the connotation here was something that you took with you to the next life.
Okay.
Right? That's where investing comes from. It's the durability. It survives a lifetime.
Yeah, but that
It's like the Patek Philippe thing, right?
Yeah,
you don't buy for
You
yourself, you
certainly
buy for the next
your-
generation. That's investing.
But that's the opposite of what's happening today.
It's not instant gratification.
But that's the opposite of what's happening today.
Yeah.
Everybody wants instant gratification.
So long as you can, so long as you know, okay, this is not investing and this is investing, you make a choice.
Yeah, but people don't. But the reality is, that's not what's happening today. You get told. I get told. I was interviewed, and I will not name them, but I was interviewed by someone the other day, a journalist, who's hopefully not listening to this, who said to me something. He's like, Ned, with everybody investing in NFT and cryptos, will robo-advisors become, there will be no place for robo-advisors in the future as everybody would have achieved their financial goals. I literally wanted to pause it and take that snapshot and go, oh my God, this is what's wrong. Like, because I love that idea that like it's the shroud, right? It's for you're meant to wrap it and take care of it. And
I have this chat with my colleagues at SmartKarma. I talk to them about, look, what are you investing your time in? That's investing too. Are you investing in skills that compound over time? Are you, it's the same principle. You must invest in something that has that durability, that sustainability, that ability to compound. Whether you apply it to your money, to your time, to your relationships. Are you compounding your relationships? Is your marriage getting stronger? To spirituality? Is your walk with God getting firmer with time? And these are not fashionable conversation topics per se, but when shit hits the fan.
I mean, I think it's super weird, right? Because so we do investing, saving for the future, right? Mm-hmm. Which has no relevance to immediate gratification whatsoever. But that's whether it's TikTok or Netflix or Coinbase or Robinhood, who have all built businesses. But the reality is, it's got to get shorter, not longer. But that's not the right way to do it, right? It's not.
Ask the same guys, is email sexy? If not,
people
why
don't
do you use
it,
it, right? Or is your WhatsApp or whatever messaging app, is that sexy tech anymore? Maybe it was. But some form of messaging, whether it was SMS, has always existed, will always exist. Soon we'll have WhatsApp for metaverse, right? But as long as everyone is clear, and to be honest, I don't think I don't see SmartKarma's role in helping people make that choice, whether you want to invest or not. We don't focus on people who have not arrived there in their decision making, but we help self-directed investors, people who have already burned their fingers, lost their money, and now have realized I need to do it right.
There's no better way to learn about investing than to lose 99% of your money. This was somebody, I think it was...
And your passport, as is happening these days.
Why?
A certain Korean individual.
Oh, yes. Oh, sorry. Yes.
Yes.
So here was a test somebody told me. So when I remember back in dot-com boom 2009, made some money in stocks. I thought I was a hero, right? I was like, look at me. I'm a legend. I'm making money. And then there was a stock, I think it was Radio Shack. Do you remember Radio Shack?
Yeah, which went up.
But at one point it went from $100 down to $1. And then I was like, it's a 1. How much lower can it go? So I put money in. Of course, it folded and disappeared. And somebody said, but Ned, think about this. When a stock's fallen from 100 to 1, it's fallen 99%. How many more percent can it still fall?
Another 100%.
You see, you're a smart investor. That's why you run SmartKarma. The natural reaction is most people go, oh, only 1 more percent, right? Because it's already down 99. So I brought it at 1 thinking, oh, how much worse can it get? Well, within 2 weeks, it was at 0. And I found out with a fairly large slap to the face. I was like, oh, right. So, and he was like, Ned, remember what I told you? He said, you're an idiot if you buy that stock. I'm like, and I argued with him at the time. He's like, Ned, do you think that will help you in the future? I'm like, yes. 3 weeks later, I'm like, yeah, no. But then I learned, right? Then I was like, so maybe the good thing that comes out of all of the instant gratification craziness is that there's no better way to learn than to get a punch in the face, right?
Yeah, or, honestly, there are times when I invest in something that is scary. I do.
Well, you did SmartKarma, that's scary.
Yeah, but, scary from the sense of it's not a proven concept yet. Let's put it that way. And the reason I do that, at that time, I'm still investing, but I have 0 expectation of making any money or retaining any principal even. But I do it as a tuition fee to get close to the founder and learn from them.
Yeah, right. Yeah.
So there have been certain angel investments where I went in saying, there's a good one, I won't name them here, but there is a private credit platform that's MAS regulated here in Singapore. Great founders.
Yeah.
Private credit is an asset class that doesn't exist in Asia.
Yeah.
I think it's going to be a fundamentally important credit asset class, right? And I don't know enough about it. I want to learn about it. I invested in this platform simply so I have the founder on speed dial.
Yeah.
And I can ask, I can learn, I can have master classes anytime I want. No expectation of ever making any money.
Yeah.
But I'm investing in something else, learning. So I think that discernment will come over time. Ecosystems mature, the RRNS comes and goes. I really don't care about that, right? I mean, seriously, it doesn't bother me. And, but coming sort of back to SmartKarma very briefly, and this is where there's an overlap here, is I talked to you about institutional investors. I talked to you about corporates, but I have not spoken to you about our youngest customer segment, which is private wealth.
Yeah.
So SmartKarma Private Wealth went live in Jan last year. So we're sort of, let's call it 20 months in.
Yeah.
It's really exciting. This is where we've taken kind of the best of SmartKarma as it would apply to individual investors and made it available at a price point that anyone can afford. And we are finally getting closer and closer to our mission to totally democratize access to institutional quality research.
Because I was going to ask that, because the reality is everyone should have access, right? Everyone should.
And that's what's happening now. So, and remember in the ecosystem, there were 4 pieces. There was corporates, investors, research providers, and intermediaries.
Okay, yeah.
So what we did right from the beginning, and this is at the heart of Bamboo.
Yeah.
You're a B2B robo API platform, to be honest. And that's what we did.
Yeah.
We said everyone should be able to use SmartKarma to serve their own clients better and save money.
Yeah.
Win-win. Move from a fixed cost model to serving your clients to a variable cost model, serve them better, and do it simply. So we've done partnerships across the board, everywhere. Institutional world, private wealth, corporates, and we'll continue to do so. So that, I think now, as we go from build mode to more and more focused on scaling and monetization and so on, we've got the whole ecosystem covered in terms of solutions. We've got partnerships in place, and now it's, I think, now suddenly people are realizing the sort of real power of the network, the research network.
I love what you said. Suddenly, 7 years later.
Yeah, absolutely, absolutely. It's like that. Amazon, go back to the early Jeff Bezos interviews. You're trying to sell books online? Who buys books online?
Have you read Upstarts? You
don't
have to see it, right? It is a book about Airbnb and Uber, and it's they showed one fantastic graph, which is the hockey stick of Airbnb. They flattened out the first 4 years, where they were literally, it's Airbnb because he took his blow-up mattress and put it on the floor, and everyone told him no, and it's not going to work, and everything. And there's that Brian Chesky, the first 4 years. It's a bit of a it's a book kind of making fun a little bit. It's great, but it really is just saying, look, like there's 4 or 5 years where you're figuring it out, and then, so when you say suddenly, to be able to do it, and we're coming towards the end because we try to keep these towards an hour. 5 years time, is SmartKarma like what if somebody who's on Stashaway or in Dallas or Nutmeg or any of these, in 5 years time, do they all have access to your research? Is that the idea?
Yeah, that'd be great. I mean, as I said, SmartKarma should be for anybody who has naturally arrived at that simple conclusion that you should be saving for the future.
But what if people haven't arrived? You don't want to, it's not your job to convert them to that.
No.
That's my job, to give them a digital tool to be like, oh, I should be saving for the future, to make it easy.
I think it's the job of any intermediary.
Yeah, right.
Because they do the KYC, they know the clients, they can educate the clients, etc.
Yep.
Our job is to make sure we deliver the service that then helps them. So, and I think that there's going to be a lot of financial literacy companies and efforts by the government. Funnily enough, this is the World Financial Literacy Week. I was at the SGX yesterday morning for the ringing the gong ceremony.
I did not know that.
And there were lots of people there focused on making people realize they need to save for the future. So I think that that's great, and I think that will never stop.
Why is it so hard, right? Like this is what we all suck at it to a degree, but in theory, money should be a simple game. Save more, spend less, yeah? Humans are really, really bad at it, right? So that number that there's like, in America, like, I can't remember the exact number, something like 50% of people have less than $400.
Yeah, something like that.
You've seen the stat, right?
Yeah.
Why is financial literacy so hard?
I think these people are probably financially literate, except they're addicts. They're addicted to credit.
Yeah, right.
And,
it's an addictive thing.
And, I think it's the wrong value system to grow up with. I remember growing up, we never borrowed.
But it's quite I hate to cliche because I'm told not to do it, but credit's more of a Western than an Asian thing, right?
Absolutely. But sadly, some of those values are permeating. Buy now, pay later.
Do not get me. So Aki, a while ago, came up with this idea. He didn't come up with it. We've seen it. Save now, buy later. Mm-hmm. Nobody wants that. It's the right thing to do. People want the instant gratification.
But that's fine, because eventually, and people are realizing it right now, suddenly, look at the millennials who work in CBD in Singapore, right? 6-7 years back, you were paying maybe $5 for your taxi ride in.
Yeah.
All in all, that discretionary spend was probably $20 a day.
Yeah.
Now it's like $30, $40 on the cab, times 2. You pay $6-7 for your coffee. Lunches are $14 plus. So suddenly you're $100 in a day.
It's crazy.
To be flat. So there is a whole generation out there that's not saving very much.
Yeah.
And that's sad. And eventually the governments will realize that, hey, why has our CPF peaked? It won't happen in Singapore. It's a very different system.
I get it.
But yeah, there'll be all sorts of social issues that arise. And there are other countries that are doing a phenomenal job. People are looking at the Indian stock market and saying, it's on 10 times book. Why isn't it falling? What's going on? Really simple. People have started investing in a profoundly new way. So SIP, the systematic investment product, bananas, right?
Yeah.
People have just figured out we need to put aside X every month, month after month, month after month, and that's going to compound. And when it compounds, we can buy the bigger house, the better car, the fancy holiday. That's great. That is what our governments should be promoting more than buy now, pay later, frankly. We need to protect, I think, the fundamental job of us as parents or governments as parents for the nation, surrogate parents, is to protect society. And, some governments are doing a much better job than others.
Yeah.
But, just, focus on the right stuff. Sorry, no offense to friends who are in buy now, pay later. I guess we'll find out.
Look, I think it's everybody in fintech's trying to do their thing, right? And whether they're committed to buy now, pay later, robo, or whatever, it'll play out how it is, right? Like I think it's and look on the digital bank.
You remember the cycles?
Do I love those things, but when the peak was. So I like sport, I like and I was like, oh my god, I can ride everywhere. I was so excited, and so I booked it when they first came out. And I was booking them. At one point, I don't know if it was over, what were they called, or Mobike? Maybe it was Mobike. It said, when there was bikes everywhere, Ned, $5 for 6 months. I'm like, guys, come on. Whoever's backing you, stop this nonsense now, right? So I think buy now, pay later won't go down the same road, right? Because the default rates, as your favorite word, for anybody who follows you on LinkedIn, is reflect. Reflect.
Which is, nobody does that.
But you put reflect, and I think it was...
People repost more than reflect.
I think you reposted about, or reflected about, maybe Klarna, but the default rates, right?
Yeah.
The default rates coming through, which were, I can't remember, 20-something%.
And I told you, I've backed a private credit platform.
Yeah, okay.
What do? They syndicate these loans and try and package them and sell them to hedge funds and whoever else, right?
Yeah.
Trust me, I've seen the numbers that are coming.
It
ain't good.
When I was at E-Trade in early 2000s, and I was in equity, so I was just selling equity, right? We did a deal with Credit Suisse back then, right? And the deal was, this is before Lehman. Okay, so we'd like you to introduce us to your clients around the region. I'm like, great. What are we selling? They're like, our CDOs. I'm like, oh, what's a CDO? So we've got the one-page sheet. You know what they are. Collateralized data origination, which for all of you who've watched The Big Short, that was the famous Jenga tower of ABC. It all fell down. So I read the one page, and I was like, I'm going to get paid for making the phone call to introduce. I'm a sales guy, right? I can't remember. I'll get 20 pips, 30 pips, I don't know, to make the intro, right? And I'll never forget what I was told by the Credit Suisse guy who came in to educate us a little bit. So here's the deal, right? There's lots of loans, but because there's so many, they can't all fail at the same time, right? So it can't go bust. Because even though there's spreads on these and there's bad margins on them, of course, they can't all go bust at the same time, right? So we're going to get paid. 9 months later, we're like, oh, wow, that's not true. Mm-hmm. That's not how it works. So the number, look, I think you can see it. The buy now, pay later, or maybe the canary in the little coal mine, right?
Yeah, look, 72% of all buy now, pay later customers in the US have missed a payment.
That's not a happy number.
But that's not reported as delinquency.
Why not?
Well, because they are not doing the same sort of reporting that a bank does on a loan, right? So is it a loan? Is there an interest? Whatever. But look, anyway, I feel there is look, EMIs have existed forever. That's fine. There is some sort of credit check that happens, which is I think good. But I think once you just lend at all costs, grow at all costs, eat at all costs, we know what happens. Morbidity.
It is not a good, and it's weird, right? Like, we talk about wealth and that, and it's hard, right? It's hard to get it right, particularly when you're offered, as you say, credit. You have to protect people from themselves, maybe. Anyway, listen, we try not to let these go over an hour. We've seen that's about the right amount of time, but I do have I get to ask you 2 random questions before we let you go.
Sure.
And these are complete, but thank you for your thoughts on wealth tech and wealth, and I hope to see SmartKarma one day. I don't know. Actually, before we do that, what's the aim with SmartKarma? What's your goal one day? You want to sell it? You want to grow it? It's your baby. How do you feel? Or you just are happy in the moment doing your thing?
Probably the last. There are people in my firm who have been tasked with the responsibility of figuring out how different people cash out and make money and so on. For me personally, I don't think too much about it. It's kind of like what the Gita said, try and do your best and leave the outcome. I'm kind of personally keeping my head there, and we'll see.
That is the best advice, honestly. Like when I was run training at a coach, he's like, Ned, every minute you think about what's going to happen in the future, you're wasting time. Just do your best every day.
Yeah.
Well, and it will be what it will be.
I remember 3 years ago, there was a Camp Sequoia, and they had Michael Phelps in.
Oh.
And after he sort of did his presentation, they said, any questions from the audience? And typical sort of Asian audience, very reluctant. Yeah. And I was like, go on. So I was
let's go.
I was like, Michael, as you're sort of standing ready to dive in, what goes through your head?
Fair question.
Okay. Honestly, it was a bit of an embarrassing answer because he's like, if I have time to think, or if I have to think at that time, I've not trained enough. He's like, it's just a machine. It's just reflex. It just happens, right? So yeah, exactly. I kind of don't want to spend too much time reflecting on the end.
Yeah.
Because then human psychology kicks in, and you start.
So SmartKarma, it's called karma. I believe in karma. If you spend time thinking about the outcome, that's not. Do your best every day. Be a good person, and it will be what it will be.
Exactly.
Right? It will be. All right. My two completely random questions that I always make up on the spot. All right. First one. You've watched Back to the Future, right?
Yeah. Long time ago.
Everybody's watched it, right?
Yeah.
Doc Brown, he's in the car. You can be in that car and you can set the dial to any year in the future or behind you like. What year do you go to?
Probably go back to my childhood.
Okay.
Maybe sort of 3-4-year-old me. I had a lot of fun. I grew up in India. We had a huge house. We had cows. We lived in the middle of a city, but my grandfather created a bit of a farm.
Okay. Which city?
Chandigarh.
Okay.
It's North India. And we had tons of fruit trees, like 6 mango trees, 2 lychee trees, whatever. Lived in a big joint family setup. It was very wholesome, Healthy food meant going into the yard and picking salad straight from the ground.
Nice.
That whole sort of farm to table, we sort of lived it.
You're organic before it was cool.
So I miss that. And the more I get older, those are the simple pleasures I miss the most, especially in places like Singapore where there's no concept of fresh.
No.
So probably that. Also because I know what I'll be getting. So on a risk-adjusted basis, I'm very happy with that.
All right, we're going to put you in the car and send you back there.
Yeah.
All right, last question. You get to have lunch with one person? Actually, I'll make it 2. Why not? Lunch is better with 3 people. You get to have lunch with 2 people, alive or dead. Who do you have for lunch with?
Oh, that's a... Okay. One person is a bit of an odd one, but one person would be a guy, the author of a book, my favorite book, back when I was a child, and that book is called The Autobiography of a Yogi.
Okay.
And it's about sort of late 19th century, early 20th century. That's the era. Guy who grew up in Calcutta, around Calcutta in East India, and sort of became a yogi.
Yeah.
And it was prophesized that one day he'll bring yoga to California or to the US. And he went out and set up ashrams in somewhere close to San Diego.
Yeah.
So his name is Swami Yogananda Paramahansa. So that'd be great because, I think it's an amazing life story.
Yeah.
Very close encounters to God and so forth. So that would be one. And I think the other one would be the other extreme. You said any person dead or alive, so we'll pick Jesus.
Go for it.
Yeah.
You can tell you some stories.
Jesus, exactly.
You would have a fun lunch.
Yeah.
Awesome. Raj, thank you, man.
And you, Nat, thanks
Appreciate
very much.
it. It's good to
Appreciate
chat.
it. Thank you.
Hey, everybody. I hope you enjoyed that interview. He's a smart guy, Raj, right? I learn a lot. I'm 55, and I love this phrase, you should live and learn. And I always say, well, at least I'm living. But I tried to learn some stuff from Raj there. So, yeah, I think his business is doing great, and he's actually making a difference in the world of research. So I hope you enjoyed it. Next week, we have another fabulous guest. So please tune back in, and we'll see you then. Take care. Bye.